Don't go with the stories, don't go with the hype, just go with the evidence, follow the evidence, and you won't go too far wrong.
Welcome everyone on the Financial Fox. Today is going to be a special episode talking about gold investment, what is happening to gold, and also we are going to make some consideration from gold, but also Bitcoin, crypto, and it's going to be a very interesting chat. And I've got some special guests with me, Kevin Wadsworth and Patrick Karim from North Star Bad Charts. Welcome, guys. How are you?
Great to see you. Yeah, it's Kevin Wadsworth and Patrick Karim, North Star Bad Charts. There you go. That's
okay. Fantastic. You've done it the best way. So let's maybe start with a little bit of background and information about chart analysis, because many of the people listening at the YouTube, they might not be familiar with that kind of approach, and I understand that for you it's kind of fundamental to understand the gold market.
Yeah, I don't know how much everybody understands about technical analysis, but Patrick and I, we are technical analysts, and we look at the charts for gold and silver and everything else, and we assess the evidence. So it's a very good way of taking out all of the emotion. We don't need to worry about fundamental stories, and we don't need to worry about news stories and who says this and who said that. We can use technical analysis to put the odds into our favor. So I'll just quickly show you something that just give you an idea of what I mean by that, and that'll just help you to understand. You see, my background is as a meteorologist. I've had 34 years predicting the future with weather forecasting, and it struck me that the techniques that we use can be used to forecast future price movements of gold and silver and everything else in the markets. And we do that, myself and Patrick was doing this as well independently of myself, and we've kind of joined forces and working together, but we're both using this weight of evidence technique. So whatever you're trying to forecast, whether you're forecasting the weather, whether you're forecasting the outcome of a horse race, or you're trying to forecast the price movement of gold, you need to know the starting point, and you need to know all the initial conditions. What is the what sort of health is the horse in? Does it have a damaged foot? What's the race course like? Is it wet? Is it dry? Does it favor this horse or that horse? If you're doing a weather forecast, you need to know the wind direction. You need to know the atmospheric pressure. You need to know the humidity. You gather all of the evidence. And in the case of weather forecasting, you feed it into a supercomputer, and the supercomputer runs the forecast, which is each one of those lines is a forecast, and they arrive at a possible future outcome. Now, if all of the predictions are pointing in the same direction, then it means you have a lot of confidence about that forecast. If they're all pointing in different directions, it means the atmosphere is chaotic on that occasion, and so the outcome is uncertain. And we can do the same with gold and silver. So we gather all of the evidence, and it's a little bit like gathering together a little sort of a tick list. And is this bullish for gold? Tick, 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 and you keep looking at the evidence, different pieces of evidence, and you end up with a big pile. And the pile either has stuff on it saying gold is bullish, or you have a large pile and a smaller pile, and the smaller pile is saying that it's looking bearish. And depending on how many pieces of evidence you've got in each pile, you can make a conclusion about whether gold and silver are at that point in time going forwards for the next few weeks or months in a particularly bullish or bearish position. So this is called ensemble forecasting, and that's how we produce the forecast and the outcome. It looks a little bit like this. You get lots of forecasts, lots of future predictions. In this case, it's temperature, and you're starting at a particular given point, and it goes into the future, and it can be the price of gold. Today's price of gold is around 1770, and each one of those blue lines can be predicting the future. And you can see how most of them cluster towards a price that's a little bit higher than it currently is. If this was gold, for example, a few of them go much higher and a few of them go much lower. So that is how we get our confidence in the forecast. If this were the case, we'd have an 80% or thereabouts, or 70% confidence that the price of gold is going to be a bit higher than it is today at some point in the future, a few weeks from now, if that's how long the forecast is for. And then you have these low probabilities of much higher prices and a low probability of much lower prices. So what you're doing is you're just kind of zooming in on what's the most likely outcome. And as an investor, that's what you want to do. You want to know exactly where the probabilities lie, so that you can figure out whether the odds are on your in your favor or not.
Wow, that's super interesting. But how reliable is this approach? I mean, can the market like surprise us with something that never happened before? So can you really make forecasts about, about gold, about everything?
There's a correct scientific answer to that, and I'll try and explain it so everybody can understand it. So if I tell you there's a 10% chance that gold is going to plunge to $1,500, if I was to make that prediction on 10 separate occasions, I should only be right once, because if I'm getting the probabilities correct, then if it's only a 10% probability, it should only happen on 10% of the occasions that I give that type of forecast. So that's the way to look at it. Not really a case of, is gold going up or is gold going down? What is the probability of gold going down? And if it's 10%, you can't rule it out, because things that have a low probability of happening do happen. Look at March of 2020, COVID came along out of nowhere and the markets crashed. And that wasn't something that was really possible to predict. A lot of the chart support levels were broken to the downside and then very rapidly recovered, because of course the charts were playing out before COVID and they continued to play out after COVID. It was a sort of a diversion, and that diversion created new chart support levels, which we're now monitoring today. So these black swan events, they create chart support for the future, but they're very, very hard to predict more than a few days before they actually happen. So low probability, the point I'm making is that low probability events do happen, and just because it's a 1% chance of happening doesn't mean we can rule it out. But as an investor, you don't want to bet on something that only has a 1% chance of happening. You want to bet on the high probability events. That means that the majority of your trades will succeed and a minority of them will fail, and that's always the aim as an investor.
Okay, so let's bring up some chart and let's start to talk about what is happening to gold.
People always look for the yin and the yang. They look in absolutes, and in chart trading, like Kevin example, we're playing the odds, and we to be successful playing the odds, you can't think in absolutes, and everything also is defined by time frame. Somebody says, is gold going to go down? And then the probabilities of gold going up. But if gold goes down, you could also say, what's the time frame? Is it going to stay down? Are we going down and then a bear market for years? Or we're still in an uptrend long term, like Kevin's going to show on that chart. But if there's a down move, and he'll show you what happened in March Madness, or even in the GFC 2008, it could be down temporarily for like 2-3 months. And then after that, the probabilities are that will get swallowed up. So
and what Patrick's saying there is typified by what technical analysts call a bullish descending wedge. So when price is dropping and forming a wedge pattern and starts to fall to the downside, that's a bullish pattern. But of course, in a small time frame, it's not bullish at all, because it's a descending wedge pattern. So you see these chart patterns where the chart goes down and forms like a wedge shape. So in the very small time frames, that's not good, because it's going down. But it's called a bullish descending wedge because when it breaks out, it goes to the upside and starts a new upward sort of bullish price movement. So you have to form these shorter term bearish price movements in order to catapult the price back up even further. And it's really just the market and investors taking a breather during an ongoing bull market, if indeed it is a bull market that you're in. This gold chart that you're looking at here on the screen here demonstrates that since the United States came off the gold standard in the 1970s, that very predictably over that time frame since the last sort of 50 years or so, gold has put in some pretty major cyclical lows between 7 and 8.5 years. It's often referred to as the 8-year cycle for gold. Well, it's, to be more accurate, it's sort of 7 to 8.5 years. And every time you get that 7 to 8.5 years from the previous major low, you get another cyclical low. So the point of this chart that you're looking at is to try and identify the time frame when we're likely to see that cyclical low. And as it turns out, it's any time between the quarter that includes December of 2022, so October, November, December this year, through until the quarter that includes May of 2024. So that'll be April, May, June of 2024. So there's a sort of an 18-month time frame there where you would expect, using history as a guide, that we would see a pretty important cyclical low. But of course, we don't know whether the gold price is, not from this chart anyway, whether the price of gold is going to go much higher first and then come back down to make that low, or whether we are currently still in the process of heading down towards that low, which we could reach later, as early as later on this year. So that's the key, one of the key questions that we've been looking to answer. And the next chart here helps to start putting the pieces of evidence in place. So this is the gold chart, and you can see that the way I've visualized it, or the way that I've analyzed it, shows two very clear what we refer to as arc patterns, or cup, sometimes referred to as cup patterns. And you get these perfect geometric arcs forming at a cyclical low, okay? And the current one formed its cyclical low in 2015, 2016, and the geometric arc pattern is an exact analog or replica of what happened in the early 2000s, when price broke out of that and catapulted up by a factor of about 8 or 9 times, from $250 to $2,000. So we're familiar with these arc patterns and what they can project for the future. Very often when these arcs complete, you get again, what's sometimes referred to as a handle, a cup and handle pattern. The handles that form on the arcs can be descending, they can trend sideways, or sometimes when an arc is complete, the price just carries on catapulting to the upside and doesn't really pause very much. So once an arc is complete, you then, as a technical analyst, have to analyze what is happening at the top right hand corner of that arc. And what's happened over the last 2 years in this particular case is that we've formed a sideways trading range between 1680 on the downside and around about 1975, 1980 on the upside, using the monthly charts. So we're trapped in this trading range. Every time it goes to the top, it gets rejected and comes back down, and every time it comes down, it bounces and goes back to the top. So what this chart is trying to do is to analyze whether we're in a similar position to 2012, and whether it looks as though we're going to break down below that 1680 level and come crashing down to $1,500, $1,400 or whatever. And this is one small piece of evidence, just one of many, that we're starting to look at and develop, that suggests there are differences, key differences between now and 2012. And the indicator at the bottom is the 7-year rate of change. And we've chosen the 7-year rate of change because 7 or 8 years is the approximate length of the gold cycle. We've overlaid on that 7-year rate of change its own 3-year moving average. That's the green line. So you can see quite clearly that when the 7-year rate of change, that's the rate of change of the gold price over the prior 7 years, goes above the 0 line and starts to turn positive, and at the same time gets above its own 3-year moving average. We've highlighted it with a green circle for you. That's a strong buy signal. And if that's also reflected on the gold price chart itself by a breakout and a move above the key moving average, like the 3-year moving average, and you're getting other bullish indications, then it's like a green light flashing for gold. It's telling you a bull market is beginning here. And you can see that back in 2020, a couple of years ago, we got that signal. The green light flashed, gold price back tested its 3-year moving average, it back tested the geometric arc, and it broke out, and it went on to break out above its key horizontal level, somewhere close to around about $1,400, that kind of area. So, but the key point to note on this is that in 2012, the 7-year rate of change was very high, and it was breaking down. Is that the case today? Is that what's happening now? Well, looking at the chart, the answer is no, it's not, because the 7-year rate of change is very low and it's rising, and it's above its 3-year moving average, which is totally the opposite to what we had in 2012. So unless that situation changes, then this chart is telling us that the price of gold and the momentum for the price of gold is to the upside. So it's telling us that any movement to the downside is likely to be limited and or very brief. So if you get a spike down, it's likely to be just that, a very quick and rapid spike. And that would be coincident with, for example, a very large sell-off in the general equities markets. If we saw the S&P selling off, there was a huge market liquidity event, then that of course would bring precious metals down. But this chart is telling us that the strength, the underlying strength, the performance of the engine behind gold and precious metals is strong, and that's a good bullish indicator for the precious metals market.
So my question, and the question of all the viewers, will be, is there a good time to buy, or we should wait, or we should wait and see? I know there are, different kind of fundamentals also happening in the real world, like the tension between Russia and Ukraine that could actually impact gold. And actually, I was listening to some comment from people say, oh, maybe the rise in gold is not happening because of Russia is selling gold. I mean, these are all kind of rumors they bounce about. But what would you say to people they are kind of trying to time? And I know that it's difficult, but should they be more towards buying or more towards hodling, more towards selling?
This chart helps to answer that question, and it's the ratio of gold to the S&P. And what you want to spot is capital flows and shifts in capital from one sector to another. So this chart is showing that the era of S&P outperforming gold is likely coming to an end. And we're seeing capital flows and capital shifts, not just this chart, but also charts like this one, which is the M2 money supply to gold, are suggesting that we're on the cusp of a very large and dramatic change in the way investors behave, not just small investors, but talking about hedge funds and the big companies looking after our investment portfolios and our retirement portfolios and all that kind of thing. So these charts are strongly, from a technical point of view, indicative of an unfolding and imminent shift away from general equities and stock markets towards precious metals, mining and commodities. If and when this chart breaks down, and the same with the S&P chart that I just showed you, if this projects and moves in the direction that is projected, and that the arc basin formation and the breakout from the descending wedge are suggesting, then we are going to see over the next 10 or more years a very, very different investing background. So to answer your question directly, should I invest in precious metals? That depends on your attitude to risk as to when you start to invest, because you can either, as an investor, you can either wait for the confirmed breakout as price moves above 1975 and the psychological barrier of $2,000, and in the case of silver, major resistance between $25 and $28. You can either wait till then and do it more safely, or my own personal preference would be to gradually scale in at these very, very low prices. The price of silver is historically very, very low compared to the price of gold at the moment. The silver to gold to silver ratio is historically very high. So in fact, my gut instinct would be to initially favor silver because the gold to silver ratio is likely to be heading down over the next few years. It may take a little while before it eventually breaks down, but a gradual scaling in silver, and also platinum, which is historically very undervalued, currently about half the price of gold. And historically, platinum is at least the same price as gold, if not more expensive. So historically speaking, if you're looking at the way these ratios perform and fluctuate over time, silver and platinum are particularly undervalued.
Do you agree on the thesis about Russians selling gold?
Doesn't matter, makes no difference. Makes absolutely no difference, because whatever the thesis is going to be reflected on this chart. So everybody's views and ideas about what's controlling the price of gold, is it JP Morgan, is there manipulation, is it China, is it Russia, all of this stuff, it's all brought together in the technical price chart. That technical price chart that you're looking at knows more than you do, and it knows more than I do. It's already got priced into it everything that everybody knows about the price of gold now and what it should be doing, but it's also pricing in everything that's going to be happening in the future. So it's all already pricing in stuff that we don't know about yet. And you can prove that by realizing that gold went up 100% from $1,000 to $2,000 in very general figures, well ahead of the bout of inflation that we've just seen and everything, all the chaos that's just happened. So gold went up a couple of years ago and it reached its $2,000 target. It's been going sideways for the last 2 years. So gold has already made its move, and then we saw lumber and copper and zinc and all the other commodities making their moves. So it's not a question of why is gold not moving because everything else has moved. Gold already went up 100% and everything else followed. Gold acts as a barometer, but not just a barometer of what's happening now, It's a barometer of everything that is known about all of these theories and all of these stories and all of these, everything that you hear about on Twitter and YouTube. It's already being priced into that chart. So we don't need to consider it. It's a complete waste of brain power to even think about it.
I love that, so don't ask why, don't try to understand why, gold is not going up, just look at the chart. I think that can tell you more than everything. That's a great observation. So, Patrick, do you have anything that maybe you want to add before I'm going to start to bring in Bitcoin and crypto?
Well, I just want to showcase people who didn't see what Kevin did since the beginning when he mentioned about collecting evidence. He collected all these clues, observations about just evidence in one chart. And after that, once he was able to establish probabilities on the possible moves within that chart, that's not enough. What he did, he looked at ratio charts, and then he started seeing one asset versus the other, or capital flows leaving one versus the other. And then after that, then that's more evidence he could add. So at the end of all of this, when somebody wants to know why we're so confident that gold on the long term will go up and is close to a bottom, it's because of all this data crunching that's happening in our heads, right? All this math and probabilities and the science behind it, it's there. So when people want to just dumb it down and say, is it going up or down? Is it going down up or like tomorrow and all that? They're not asking a good question, because this is a probabilities game. And there's like one other chart, and we're probably going to touch on it later. It's let's say the SPX has broken down versus the producer price index. And those turns, they take a couple of years to really turn. And to answer your question, like Kevin answered brilliantly, where do I buy gold? Unless you're a day trader and you have a super close sell stop and you just want to make, like, buy the ultimate bottom and then make money, the market's going to crunch you up, because yes, there's a black swan event, even if it's 1 times out of 10, it's going to trigger you out. So like Kevin said, right now, we're on the big picture, we're definitely at a turn. So if you want to take a gold position, I would probably think 2-3 years to buy everything you want to buy, and then you're going to ride it for another 5, 6, or 8 years after. So every time you buy. So if you bought now at 1,700, even if it crashes to 1,500, buy a little bit more, then goes back to 1,700. And over the next 2 years, as this ship is turning, then you'll have your position that you'll be able to ride until 2028, 2030, or later on. But trying to time it and putting like all the money you got to try to be a millionaire overnight, that's a recipe for disaster.
It is a fantastic statement that you just said, because, it can apply to many other things like crypto as well. Don't try to time it, but do dollar cost averaging investment. And that is going to be your best option over time. So I'm really glad that, you brought that
Especially
up.
Because the time frame, people have to see everything is defined by a time frame. If you're looking at monthly candle charts like we are, and you won't even see an intra-month dip that goes 30% down. For day traders, scalpers, fine. If you're on the hourly chart or daily chart, you're gonna do the same math and science that we're doing, but applied to a smaller time frame, and then you'll have you'll be more sharp on those small moves. But when you look at cycles that we're looking at, macro defined capital flow cycles that last 8 years, you can't pinpoint the day exactly that's going to be it. You might think that's a day, and then, oh no, it goes down more, but by the end of the month, it's back above the previous, and you're still fine.
Okay, let's talk Bitcoin and crypto, because I was hearing things like, the gold era is finished because Bitcoin is the gold of the new generation, and there are so many people, they kind of think, gold is finished, has got its time, has got its fun, has got its ride, but now is the time, the era of the crypto people. Do you agree on that? And if you don't, no, okay.
No, but again, because you just have to clear your mind of all of the discussions, all of the stories, all of the rumors, all of the opinions, and just look at the chart. And just quickly, before we look at the Bitcoin chart, I just want to explain. I know a lot of people will be watching this thinking, well, Kevin, Patrick, you're talking absolute garbage here. Technical charts are a waste of time. It's voodoo. It doesn't mean anything. I know a lot of people are very, they find it very hard to believe that you can look at a price chart and all of the evidence that we've been talking about, and actually determine anything about the future. So just quickly, I wanted to show you this chart here. Shows you what I mean about being able to use technical analysis to project into the future. The chart on the top left-hand corner there was my prediction for the price of gold, and I issued that chart in 2019. And you can see at the chart in the bottom right-hand corner there next to it that the price of gold over the next 3 years, between 2019 and 2022, did exactly what I said it was going to do. Now, a lot of people watching this will say, well, that's a one-off, you know, it's a fluke, you know, anybody could have done that. Well, it isn't. I promise you it's not a fluke. You know, we've done this over and over again many times with copper, with oil, with cryptocurrencies, with uranium, miners, you know, all right across the markets. And the way that we do it is, as I say, by gathering the evidence. In this particular case, it was a clear cup pattern forming that was breaking out, and it was very evident that we were likely to see a back test of the breakout. We got that back test. The price then accelerated to the upside. It reached the previous all-time high, and then at the point where I said it was going to sort of pull back and form this handle consolidation, it did exactly that. The handle formed on the cup. You don't necessarily, as I said before, when price gets to the top right-hand corner of an arc formation, there's no certain way of knowing whether the price is going to continue straight up or whether it's going to form a consolidation. But in this particular case, for gold, the gold price to double in that time frame, it was highly likely, the odds were in favor of forming a long consolidation of at least a year and a half to a couple of years. And price actually broke out at exactly the point that I said it was going to in 2022. And what made it happen and go back to nominal new highs, I didn't know in 2019 what was going to cause that to happen. As it turned out, it was when Ukraine was invaded by Russia, and the Russian forces crossed the border into Ukraine. Now, I didn't know that was going to happen in 2019. So it's an illustration of the news story comes along to fit the chart. It's not the other way around. It's not the chart that's created by the news story. It's the other way around. The news story and world events will coalesce around what the chart is telling us is going to happen. So the chart told us that inflation was going to break out. The chart told us that producer prices were accelerating to the upside. The chart told us that we'd had a breakout of energy prices in Germany 2 years ago. And now all of a sudden people are talking about energy prices in Germany and the fact that, you know, natural gas prices and electricity prices in the European Union have gone through the roof. But that was set in motion 2 years ago by the chart breakout that we identified. Nothing to do with what's going on today. So the news stories will come along, and it's almost misleading in a lot of, well, it is misleading because it was written in the chart long ago what was about to happen.
This is how it works. It's capital flows drive the price. So the big money, where's it going? Is it going in growth or value? Then price drives the stories. Because without price appreciation, nobody's talking about it. Because Bitcoin, when it was $1, nobody was talking about it. People are living in the past. I'm talking about Bitcoin today, or all these Bitcoin guys. It's because Bitcoin went up $10,000, because the price appreciated, because it's a tech bubble and money was going in away from gold in 2011 towards crypto and tech stocks. So people got it all the way around. By the time we say it, it's too late.
Yeah.
And that is the trap. So charts is the only place you could see the what's going to happen next before the narratives. Because it said, look, if you overlay the recession chart, since over the gold chart, silver chart, gold and silver actually bottom at the abyss of a recession. When everybody thinks it's the end of the world, we're going to Great Depression, that's when gold bottoms and thrives out of the gates. And essentially, that's why I'm kind of tired of hearing about inflation. I want to start hearing people talking more about deflation, and I'll know my bottom, my contrarian bottom along with the charts for gold and silver will be in. Because if everybody's looking at inflation, that means you got to still be wary a little bit that, you know, gold and silver will bottom when people think it's the end of the world, but not like as a fear trade, but when nobody talks about inflation anymore. And it's starting to creep up, right? People are already not expecting maybe as much inflation next year. So that's what I'm looking for.
Okay, makes sense.
So to apply the same logic to Bitcoin, this is the Bitcoin roadmap that we put out for our members quite some time ago now. and Bitcoin was at $36,000 at the time, and it was the clear sign of the breakdown and the fact that we were going to move down to the orange support level, then the red support level, then quite possibly the grey circle that you see on there. And you can see, looking at the indicator on the bottom of the chart, that's the stochastic RSI indicator. If you're listening to this and you don't know what that means, it doesn't matter, because all you need to know is that when that little graph on the bottom is in the white zone, where the red, the red box with the question marks in it, where when it moves into that, I've called it the plunge zone. And when it moves down into that plunge zone, you can see the evidence on the chart there. Each time it does that, the price of Bitcoin plunges. So it was very, very clear that the chart was sending us a signal that that was about to happen. We're about to see a plunge. And of course, we went down to around about $18,000 on Bitcoin. We've had a bear market rally up into the low 20s of thousands of dollars for Bitcoin. But until or unless Bitcoin breaks out through its key resistance line, which it is unlikely to do in my view, then we are in a bear market rally. The breakout level is somewhere around about 25,000, I think it is, the resistance level. We sometimes call it a sleep mode line, because there's a line put in place on the chart, and that stock, or in this case Bitcoin, it goes to sleep and it's in a decline, and it just means you don't touch it until it breaks out through that line and wakes up again. So Bitcoin hasn't woken up from its sleep at the moment. It's in a bear market, and in my view, it's still very likely that we go down to somewhere around about $12,000 or lower for the bear market bottom late this year or early next year. I'm quite happy to be proven wrong. The chart will tell me when, if and when we need to turn bullish on Bitcoin, and at the moment it's somewhere around about that $25,000 mark. But Bitcoin's some way off doing that at the moment, and I strongly suspect that we've got lower lows lying ahead of us. But we don't need to sort of speculate about that, because the chart will give us a signal as soon as it breaks out, as soon as it gets above its 200-day or 30-week moving average. Then we can start to get a little bit more optimistic for Bitcoin. But you have to remember, just the Bitcoin and the crypto markets have never dealt with a bear market in general equities, and the Bitcoin chart and the crypto charts are very closely following the Nasdaq and the tech stocks. So until proven otherwise, Bitcoin and crypto are strongly tied to tech stocks. So
not to gold.
No.
That's the point that I wanted. I was just going to jump in and say, is Bitcoin behaving? Should we expect a behavior like gold? But you're basically saying not.
We have so far, until there is evidence to prove otherwise. And this is where the science comes into it. You have to stick to evidence. What people think and what they're speculating about and views and opinions, it's all fine, but it's just kind of messing around in your head, when all you need to focus on is the evidence in the chart, the scientific evidence. And if Bitcoin can decouple and start to become some kind of store of value and prove something, in other words, that when the stock markets are falling and general equities are going nowhere, if Bitcoin and the cryptocurrencies start to show strength, then fine. But at the moment, that hasn't happened.
Well, it sounds very clear that Bitcoin is not the new gold then.
No.
Not on the evidence yet.
No. And people, they have to differentiate price and value, or wherever something is. And people think Bitcoin has more usage because it was 60,000 than it was 10,000. But no, Bitcoin's a Bitcoin. It does what a Bitcoin does, or whatever, replace Bitcoin by whatever it is. And people think, oh, they get a good feeling. Oh, it's up 60,000. The market's adopting it. It's ETFs buying it. No, that's the danger, because after that, you fall in love. You stop looking at the price action. If it starts breaking down, you can't let go, because you believe in the story. Well, you're going to believe in the story for the next 10 years as this thing's going down. What are you going to do and explain to your wife that you lost all your money because you follow Michael Saylor's advice? So follow the charts. Don't get attached emotionally to anything. And if the chart tells us to sell gold, we're going to a bear market, and we will eventually, it's going to go hibernate, and US equities are going to outperform gold, we'll be out of there. We're going to flip the ratio is going to tell us to go long growth stocks, and we'll do that. But right now, Bitcoin has broken down versus silver. It broke down versus gold. It broke down versus the producer price index. The SPX broke down versus the producer price index. NASDAQ broke down versus the producer price index. The next step is like when SPX breaks down versus gold, or gold breaks out versus SPX, that's the death knell. So usually when that happens, it's 6 to 8 years where you have to be long commodities. And that's where we're at. We're at that turn, and people have a hard time accepting it. But the thing is, you just don't know how long it's going to last. And like Kevin said, once you go below the sleep mode line, then there's a descending trend line that creates resistance, the wake up line. Until you close above that, why just pray and hope and just waste time? Just go to the next asset that's going up.
Exactly. And read the chart. That's the most important thing. So my plan was actually to discuss some ways to invest in gold, but I think we can leave them. We can leave this for next session that we are going to have later on this month. So for now, I think the most compelling takeaway from this chart is start to look at the chart, start to study chart analysis, which is what you're doing. So it would be great if you can share maybe some links or where people should go if they want to get on your analysis material.
So northstarbadcharts.com.
Okay.
It's on Patrick's hat, and you can also see us on Twitter. I'm Northstar on Twitter, at Northstar, at Northstar Charts, in fact, and Patrick is at BadCharts1.
Okay, fantastic. So everybody start to do some proper research, look at the chart. I'm going to do it myself because I think, that point about you start to believe in the story, you start to look at the price, you start to get excited, and then you have to justify your big losses. I think that's, a very important point. And skilling up on chart analysis sounds a good idea.
Yeah, it does, Stefania. I highly recommend it. Don't go with the story. Don't go with the stories. Don't go with the hype. Just go with the evidence. Follow the evidence, and you won't go too far wrong.
Okay, thank you so much, Kevin and Patrick, to come on the show today, and we will chat again soon about way to invest in gold.
Awesome.
Look forward to it.
Thank you. Thanks.
Thank you,
Stefania.
everybody for watching. Bye.